Get started. Mayhem. Good morning. We're talking about Social Security today. My name is John Ravick. I'm with Everhart Advisors. And Social Security is this really misunderstood topic. It's very confusing, even to financial advisors. There are so many nuances and nooks and crannies, and it requires explanation. But it's really important to our society, to most of our clients that use Social Security as a cornerstone to their retirement income plans. So I applaud everyone who's attending today for engaging in this process because Social Security is going to be very, very important to you. Also, you've been paying into the system for a really long period of time. So many people, when they trigger Social Security benefits, they've been paying into the system for 40 years, 50 years in some instances. So you want to get your money's worth here. You want to make sure that you're making the right decisions when it comes to Social Security. So we're going to go through a slide presentation, and I'm going to share some nuances of how the system functions. But rely on your partners at Everhart Advisors if you have questions about your specific situation. Because what I'm going to be sharing with you today is general information, basically from the Social Security Administration, but how it pertains to your particular situation is is granular. It has to do exclusively with you and your spouse and your working record and your tax situation or employment situation. So some of the information that I'm going to be furnishing to you today is for informational purposes. But as far as personal planning goes, that's something that you should definitely be connecting with a professional advisor, a tax professional, or the Social Security Administration to get specific information about your situation. So I'm going to go through a slide presentation today, but I hate slide presentations because I would rather just have a conversation with you about this really, really important system. So I'm going to start out conversationally, and then we'll move to the slide presentation. So the first thing, I want to address three topics that I think are very, very important before we go into the formal presentation. And the reason I'm doing this first is because I want you to get value out of this webinar today. And the primary questions that people have for me about Social Security are not about survivor benefits or the $255 death benefit that they pay a beneficiary in the event of a Social Security recipient's death. I mean, that stuff is, I guess, important information too. But what people want to know about is the system solvent and is it still going to be there to pay me my income? That's one thing. Two, when should I elect benefits? And the third topic that I'm going to reference just briefly is about the SAVE Act, which is legislation that was passed recently that allows individuals who are entitled to a public pension, like the Ohio Public Employees Retirement System or state teachers retirement system, to also receive payments from the Social Security Administration if they had private employment during which they made Social Security FICA tax payments. So let me start out with the solvency of the system, and we'll reference this in the slide presentation as well. But a question that I hear from clients and 401k plan participants constantly is it going to be there? I paid into the system for a really long period of time. Am I going to get anything out of this? You hear the alarmism and the fear mongering in our online discourse and political discourse. And everybody wants to point the finger at somebody, some politician or some group that you don't like, or, to scare you basically into the idea that you're not going to get any Social Security benefits after paying into the system for decades and decades. First of all, I don't know what's going to happen. So I can't tell you definitively what's going to happen with the solvency of Social Security. But I would like to reference a statement from the Social Security Administration's website that frequently it used to appear on your actual statement. And it says this: without changes to the current system, in 2033, the Social Security Administration will only be able to pay 77 cents for every dollar of promised benefits. Okay, so they're warning you that there are solvency issues. And I don't think it's a secret. I think people are aware that Social Security has solvency issues. Solvency meaning that they are not necessarily collecting enough tax revenue from current workers to pay out all of the Social Security recipients for all of their prospective lifetimes. This is a significant issue. It's a demographic issue. I would argue it's not a political issue. It's not Congress's fault. It's not Trump's fault or Biden's fault. It's a demographic issue. We have a lot more beneficiaries or retirees now than we had previously. Thank God. It means that we are working and then living longer in retirement than previous generations. I think that's a good thing. But the statement that I referenced before says, without changes to the current system, they'll only be able to pay out about 3/4 of the benefits. Well, first of all, let's break that down. Without changes to the current system, there will be changes to the current system, almost certainly, to keep the system more solvent. What those changes, I don't know exactly, but a high likelihood is that they raise the taxable wage base. Taxable wage base is the amount of income that individuals pay Social Security taxes on. It's not all of your income. For many people, it is, but there's a threshold. It's $176,100. If you make more than $176,100, the income that you earn above that threshold, you do not pay Social Security FICA taxes on that income. If you're a Shohei Ohtani in the World Series this week and you make hundreds of millions of dollars, you don't pay Social Security taxes on hundreds of millions of dollars. You only pay Social Security taxes on the first 176,100. That number is probably going to go up. To what? I don't know. And I'm admittedly anti-tax, so I don't love the idea of additional taxes, and Social Security needs to remain solvent. I'm realistic, and to keep it solvent, you'll probably see the taxable wage base increase to $250,000, $1 million, completely uncapped. I don't know the answer to that question, but we will probably fund Social Security with additional taxation. That seems very logical. It will also probably make us work longer. No, not you. Not you who's on this call, who's thinking about triggering Social Security benefits soon or in the next 10 years, not you, but my children who are 7 and 9 years old, who can't vote, they can't make any, they don't have any say in this. Full Social Security retirement age for most of the people on this webinar is 67. No, I'm not going to do any 6-7 jokes. For any of you who have little kids, you've probably heard this stupid meme about 6-7. We're not doing that today. But we're going to see the age increase, and it probably should. And that's because life expectancy is increasing. Social Security was enacted in 1935. Life expectancy was very different then than it is today, and it will be very different when my 7-year-old reaches age 67. 60 years from now, life expectancy is going to be longer. And God bless him. God bless those children. They're probably going to see more life than we do. It's like we are seeing more life than people born in the 30s or people born in the 1800s did. So those are two changes that will probably happen with the Social Security system. Also, the statement is that the Social Security Administration would only be able to pay out 77 cents for every dollar of promised benefits. Well, that's a lot different than the gloom and doom that you hear in political discourse or when I talk to young people and they say, well, I'm not planning to receive Social Security benefits, any benefits. I mean, 77 cents per dollar is not the same thing as saying that there will be no payments, which is what I hear when I talk to general public. Okay, the other comment is about when do you elect Social Security benefits? When's the best time to get these benefits? Mathematically, we have software that we can use to determine the absolute best day to get full maximization of benefits out of the system. The system always tells you, our software always tells you to elect benefits at 70. Why? Well, because you have to put a date of death into the calculation. You have to tell them how long you think you're going to live in order to create this break-even point calculation. Well, when do you think clients put their date of death as? Do they list it as age 61 ever? No. They always list it as some age out into the future, 90, 95 years old. If you live that long, it does make sense to push benefit election out to the longest possible point because you get more Social Security benefits for waiting to elect. You get delayed retirement credits, which are 8% increases in the amount of your Social Security benefit annually every year you postpone taking your benefits. So if your full retirement age is 67 and you don't elect benefits until 70, you get 8% increases or almost a quarter more benefits, 24% more benefits. 25 years, age 70 to age 95. Okay, that's true. If you live to 95, you don't know your date of death, and neither do we. Furthermore, when do you get to spend the money? Sure, maybe you're getting more Social Security benefits and you live to 95 years old. What are you using the money for at age 92 and age 94? I just don't know that it's that valuable practically. So in response to the second topic I was referencing, when should you trigger benefits? Often the answer is when you need the income. That is usually when people stop working. So you stop working at 65 and you go on Medicare and you need income. Well, a lot of your income is going to come from Social Security, and some of it will come from your wealth, your savings, your 401k, your CDs. Other people have forms of income. Pension is becoming more rare, farm ground, rental income, annuities. There's other forms of income. But for most of our clients, income comes from two sources: Social Security and wealth. Well, clients don't usually like entering retirement, and they have an income stream, Social Security. They choose not to trigger it. Instead, they use their wealth. They don't like that because they enter retirement and immediately start watching their wealth dwindle in value because they're using it to pay for vacations and living expenses and philanthropy and taxes and insurance and medicine. So they'll often trigger Social Security benefits. And frankly, I don't fault them for that. I like the idea. Get while the getting is good. You paid for this benefit for 45 years. You're 66. You need money. There's an income stream that you could take right here, Social Security. Should you trigger it? Well, I mean, you will get more if you wait, but you got to wait. And people don't like waiting. And we're an instant gratification society. So anyway, that's my philosophy on when should you trigger benefits. The answer is when you need it to provide income as part of your retirement income stream. Now, I do work with some high net worth people. God bless them. Good for them. Yeah, 5 million bucks or more, and they're not going to spend all of their wealth throughout their lifetime. And it's very much intergenerational conversations for them. Family tree money. Okay, good. Good for those people. The 0.25% of the population that doesn't need Social Security benefits, they might be using a wealth maximization strategy, and they trigger benefits at 70 because they're never going to use all of their own personal accumulated wealth anyway. So it's all just going to trickle down to children and grandchildren and future beneficiaries anyway. Maybe for that person, we're talking about maximization. But for most people, we're talking about day-to-day living. Like, how are you going to pay for your wintering in Florida and your Buckeyes games and your grandkids, Christmas presents and all of those kinds of things? Well, most people need income for that, current income. Social Security is a great source for that. So anyway, a couple thoughts about when to trigger benefits. Last comment before we get into the slide presentation is about the SAVE Act. The SAVE Act has changed what used to be called the windfall elimination provision, which was a coordination of benefits between public pensions and Social Security. Where if you were a person who was entitled to a public pension, like you worked for the county or you worked for a school district, and you're entitled to the state teachers retirement system pension, that there could be a coordination of benefits and you're not entitled to Social Security benefits, even though you may have paid into the system for many years during private employment prior to or after your public employment. The SAVE Act has made it possible for some of those individuals to recuperate some of the taxes that they paid into the system in the form of a lump sum payment from the Social Security Administration. Yes, I mean a check that is sent to you by SSA. So if you are in that boat, you should be contacting Social Security and asking them if you are entitled to any compensation as part from the SAVE Act. So that's just a word to the wise that the worst they can tell you is no, you're not entitled to anything. Find out at the very least. It's where you are right now. So there's no cost other than the opportunity cost that it takes to call Social Security. Now, that opportunity cost can be significant. It's reaching someone and scheduling time to speak to a benefit specialist from Social Security. It is challenging. You will wait. I mean, it could be a month before you speak to someone. But the good news about Social Security is it's a retirement program for most people. There are disability benefits and widows benefits and dependent children benefits, but for most people, it's retirement. Well, retirees have time. Most of them have some time during which they could make a call to Social Security or schedule time to go to one of the local offices and schedule time to meet with a benefit specialist. Now, I say that, but a lot of my retiree clients also tell me that they are busier in retirement than they were during their working years, and I love that. They're busy with grandkid stuff. They're busy with their hobbies and travel and their adventures. So I love that. That is extremely exciting. But most of you will have the ability to carve out time to make a call to Social Security about the SAVE Act, and it's advisable if you have dual employment, some public employment, some private employment. All right, without further ado, I will send it over to the slide presentation. So let me share my screen here. Okay, as I said, I hate slide presentations because it takes some of the interpersonal relationship out of it. So the first slide here is about when should you, what these Social Security decision points. So, oh, display settings. Okay. So, little known fact, you can elect benefits from your 401k plan as early as age 55 without a tax penalty. It's only the 401k plan that you retire from. But a lot of people think that this age 59 is the magic number. And it is, of course, that's when you can elect benefits from a 401k plan without a tax penalty. You can elect benefits as early as age 55 without a tax penalty from the 401k plan that you retire from. Age 62 is the earliest you can elect Social Security benefits. You get a reduced benefit if you elect at age 60. You get Medicare at age 65. So obviously that is probably the most common retirement age, is age 65, because at that point you're eligible for both Social Security benefits and Medicare. You get your full Social Security benefit for most people between ages 66 and age 67. And again, for most people on this call, it's going to be age 67. You know what? I'll tell you what. I am going to stop sharing my screen for 1 second here, and I'm going to pivot to a different presentation here. Because I don't like the way that was showing up. All right, here we go. At age 67 is when you can get full Social Security benefits. Age 70 is the maximum benefit. So here's another nuance. If you get to age 71 and you have not elected your benefits, you must do so immediately. They're not going to call you and tell you that it's time to trigger your benefits. You have to notify them. And if you haven't done so by age 70, you're missing the boat. You're not going to get extra dollars from them. They will pay the 6 months worth of payments, but don't get to 72 and 74 years old and you have not started electing these benefits. And age 73 is when you have to start taking money out of a qualified retirement plan, like an IRA or a 401k plan. These are called required minimum distributions. And that age is going to be 75 if you were born in 1960 or later. So that's commonly misunderstood as well. People think that RMD age is 70 and a half, which it was. And then it got moved to age 72, and then it got moved out to age 73. And it'll be 75 for some of the people on this call as well. All right, so Social Security basics, it is a retirement benefit. It was never intended to be the only source of income for people when they retire. We'll tell you, it's just a funny little tidbit here. The first person who ever elected monthly Social Security benefits was named Ida May, and she started receiving the monthly benefits in 1942. She was getting $22.54 per month. She lived to be 100 years old. So they clearly did not understand the demographic issues that would face the system, which is that people are living longer, because the first ever monthly recipient did not live to life expectancy. She outlived life expectancy really dramatically. Another fun tidbit, the first guy to ever get a benefit was named Ernest Ackerman in 1937. And he was only in the system for 1 month. He paid 5 cents into the system and he got a lump sum payment of 14 cents. So I love those little Social Security nuggets. That is fascinating to me. Social Security does have preferential tax treatment, and there are spousal and survivor benefits that we will talk about during this slide presentation. So this is a really important slide. When do you become eligible for benefits, and how do they determine the benefits? The joke that I use with this slide is, what if we played a high stakes poker game, and it was going to be at my house tomorrow night? Okay, and you're going to pay 8 grand into this poker pot. But nobody will know who wins the hands at the end of the game. I will tell you whether you won or lost each hand. I'll be the sole determiner of the winner of these hands. No one would play in that game yet. And Social Security, every year we give them, depending on your income, $6,000, $10,000, $25,000 every single year. And nobody knows how the benefits are determined. You're entitled to X amount, you're entitled to Y amount. Nobody knows. Well, first of all, you become eligible for benefits once you have what are called 40 retirement credits, and you earn a credit for every $1,810 that you earn. You can only earn one credit per quarter. So for 40 credits, you have to work for basically 10 years, earning more than 1,800 bucks a month. If you do that, you are automatically eligible, or what's called fully insured in the Social Security lexicon. Once you're fully insured, you can start receiving monthly payments as early as age 62. You can get widow's benefits as early as age 60 if you're a survivor. I'm sorry, if you're the surviving spouse, but 62 for retirees. Now, 62 is a very common age for when people trigger benefits because of what I said before. They get to that point and they say, hey, I paid for this thing. I've been paying taxes for 40 years. I want my income. I'll talk about in this presentation why you might want to reconsider that, especially if you remain employed, if you're still working. Okay, so once you become fully insured, how do they determine the amount that you are entitled to? Well, a lot of times I hear all these misconceptions about Social Security benefit calculations. How do they determine what you get? Well, it's based on the final 5 years of employment or your highest 3 years worth of wages or something. It is not. It's based on 35 years worth of earnings records. So, another question that comes up is, well, I'm making the most I ever have in my lifetime. If I work for one more year, I could really bump up my Social Security benefit. Not really. It helps, of course, every year that you work at a higher income, it increases the benefit. But does it increase the benefit materially? Not really, because it's based on 35 years worth of earnings. So one extra year is just one more data point in a 35-year average. Now, the earnings that you earned prior to 2023 are indexed for inflation. So obviously the dollars that you earned in 1989 are not worth the same as 2025 dollars. So they index them for inflation and then rank all of them 1 through 35, and they average that out. And that is called your average indexed annual earnings. And your monthly payment is based on that figure, run through 3 decision-making points that are called bend points, you can Google Social Security bend points if you want to know the absolute to the penny calculation. It is confusing. And I'm happy to explain it after the slide presentation if anybody wants to stay on and I can explain what the bend points are. But needless to say, there is a maximum. So you could make, your current income, or you could make income like Shohei Ohtani on the Dodgers. You still can only get about $4,000 a month maximum at full retirement age in 2025. That's about the most that you can get. So allow me to pause there and explain why the taxable wage-based conversation that I shared at the beginning is meaningful, okay? Because sometimes people will say, hey, it's an easy fix to fix Social Security. Just make the taxes uncapped. Okay, well, the tax that is assessed to your income for Social Security is 6.2%. Let's say you're a person who earned $1 million in a year, like a baseball player or cardiologist or something, and you make $1 million bucks, and you pay 6.2% of that. That's $62,000 a year in taxes that you're paying for a maximum benefit of about $48,000. So there's subsidization that is happening. Now, the level of subsidization that we have set right now is $176,100, and I think that it's reasonable to say that that number is going to go up and probably should go up. But uncapped creates a situation where you have some people who are high earners paying massive, maybe millions and millions of dollars for a benefit for themselves that could be maximum about $48,000. And the Social Security system has basically set this level and said, okay, well, that's where we're setting the subsidization right now. But will it change? Probably yes. Okay, and Social Security benefits are subject to cost of living adjustments. We just had the announcement of the 2026 cost of living adjustment. It's 2.8%. So you beneficiaries will get 2.8% more Social Security benefits in 2026 than they received in 2025. And that's true for all beneficiaries. This is a sample pay stub, and it's showing Social Security taxes. Sadly, they don't show it like this on your actual pay stub. They just call this part here FICA, Federal Insurance Contribution Act. I wish they showed it like this. Social Security and Medicare, what are you paying to these respective systems? Because first of all, nobody looks at their pay stub anymore. The money just goes into the bank account and they live. And that's probably not advisable. Go look at it. Go look at your most recent pay stub. Why? You want to know where your money is going. You should be knowledgeable about that and engaged in the financial planning process. For instance, taxation. Where's your tax dollars going? If my local tax is going to the state of Ohio or my local municipality, I'm looking at the end of the year, I've paid these people, thousands and thousands of dollars. Well, that makes you a more engaged citizen. Now all of a sudden you're thinking about this and holding the politicians' feet to the fire for where your dollars are going. Or in the case of Social Security, you're getting engaged in the system and saying, like for this person, year to date, what is this through March? They've already paid almost $700 towards Social Security. Well, if you're this earner, you should be sitting there going, "What am I paying for? What did I get out of this thing?" And it just makes you more knowledgeable and better prepared for retirement because you'll know that you're paying. The reason people don't know anything about Social Security is because the taxes are taken out in a compulsory manner. You have no say. Once you could be working at Skyline Chili or Chipotle, or you got a paper route. You're a 16-year-old. You're paying Social Security taxes. Nobody knows that. They don't know because it's taken out in a compulsory manner. If Social Security sent them an invoice and asked them to mail in a check for $115, who would say, "Now, what am I sending this money in for? Who's it going to? What do I get out of it?" I think that would be a better system as far as understanding the system, which is critical. All right, so items to consider. First of all, are you going to continue to work? So when it's time to elect benefits, are you going to keep working? Are you 62, but you're still at your job? And if you work when it's prior to full retirement age, there is a reduction in benefits that happens. It's $1 of reduction for every $2 earned over a $23,400 threshold. If you keep on working, you're making 80 G's a year. You might not get benefits. Trigger the benefits, but they're not going to pay you because you're so far over the threshold. So we'll talk about that in great detail in a couple slides here. Longevity. How's your health? If you've already had multiple cancer diagnoses and you've survived, praise be to God. That is amazing, first of all. You may be looking at this and saying, time is precious. I'm not waiting to 70 to elect benefits. I'm going to elect benefits at 62, and I'm going to start using my Social Security benefits for travel and grandkids and philanthropy. And I think you should do that. Or conversely, is there an expectation of longevity? Do all the women in your family live to 96 years old? Your mom, your aunt, your grandma, they all live to 96. Probably going to live to 96. In that case, maybe electing benefits at 70 does make sense. Or waiting to trigger benefits because you get those delayed retirement credits beyond full retirement age. These are considerations. And are you married? Is there a significant age difference between yourself and your spouse? Whose benefits can the spouse collect? Was the spouse previously married and they're solely entitled to widow's benefits or something along those lines? These are all considerations that should be considered, probably in conjunction, in conference with a professional advisor. Oh my goodness gracious, this data is so crazy. Okay, this is about life expectancy. This data is from JP Morgan Guide to Retirement 2024 edition. If you're 65 years old today, first of all, these are the life expectancies for individuals at age 90. For women, it was 84, and men, it was age 80, a 4-year age gap. By 2021, life expectancy had increased to 84 and a half and almost 82 for males. So that's now the gap is shrinking. And the expectation is in 2090 that it'll be almost 90 and almost 87 years old. But what these colored bars are showing you is that for women, the life expectancy or the probability that a woman who's 65 today lives to age 85 for a healthy non-smoker is 72%. For a male, it's 63%. In other words, high probability. And then for a married couple, the chances that one of the two of you lives to 85 years old is a 90% chance. Okay, so let that sink in for a second. 90% chance one of the spouses in a married couple lives to 85. That number for age 90 is 73%. There is a 3 out of 4 65-year-olds who are married right now. One of you is living to 90 years old. There's high probability of that. 95 years old, it's almost a 50-50 shot. 100, 1 in 5. Now, my mom is in a retirement community, and there are a couple centenarians there. They're over 100 years old. They're all women. They're all women. There are no 100-year-old men at her retirement community. dare not comment on the reason for that, but I'm just telling you from my empirical experience, obviously statistically women live longer, and the chances of them making it to 100 out of these couples, it's usually females. Okay, so what is your actual full retirement age, or FRA? FRA is a acronym that is used in the Social Security lexicon, and it is everywhere. Your benefits are based on your FRA, fully insured amount. For most people, it's age 67. It may be some shade here, 66 and 4 months or 66 and 8 months, but for the purposes of today's conversation, we're mostly going to focus on age 67. And these are the increases or decreases that you receive if you elect benefits prior to full retirement age, which is this column, or after full retirement age, which are these 3 rows. Again, I'm focusing on age 67, full retirement age. It changes if you're 66. But for an individual whose full retirement age is 67, if you elect benefits at 62, you lose 30% of the benefits forever. It's a permanent election. That's a lot less money, but you get it sooner. You get to use it and possibly invest it or pay down debts or whatever, or live. Yes, you get more for triggering benefits later. I have clients who work for a really long period of time. They love what they do. Good for them. If they don't need income, maybe they are pushing benefits out to 69 or 70 years old. But I will say that's the minority of people. Most of my clients are reaching retirement. For instance, they get to 65 and they say, I'm eligible for Medicare. I've worked for 45 consecutive years. I paid my dues. I raised the family. I paid the taxes. I did all the mom and dad stuff and all the good civic citizen stuff for decades. I want my money. Good for you. Trigger the benefits. Yeah, you get 12% less than you would at 67. But if you need the income now, they love it. They're on Medicare. My clients on Medicare, which, by the way, is next month's Everhart Advisors University session, is Medicare. They love Medicare. Medicare is a good system. Social Security is a good system. My retiree clients live on these things, very, very critical to our society. But you get less if you elect early. Okay, this is a slide that talks about the annual earnings test. The annual earnings test is an income threshold above which there is a recuperation of benefits that happens if you have not reached full retirement age. Again, we're going to focus on an age 67 full FRA, or full retirement age. If you earn, let's say you work, you're still working, but you hit age 62 and you decide you want to start taking your Social Security benefits, which you're entitled to. But if you earn more than $23,400 a year, Social Security recuperates $1 of benefits for every $2 that you earned over the threshold. So let me use an example of a person who earned $43,400. That's 20 grand over this threshold. And you're not at full retirement age. Social Security will recuperate $1 for every $2 earned over the threshold. Well, in my example, the excess earnings were 20 G's. Social Security will recuperate $10,000 from you. How do they recuperate it? They don't pay you. Let's say your monthly benefit that you were entitled to was $2,500 a month. Well, for 4 months, they just don't pay you. They just don't send you a paycheck, because that would be $2,500 times 4 months is 10 G's. That's the amount of the recuperation. They just don't pay you, and they pay you for the other 8 months. So that changes when you hit full retirement age. In the year that you reach full retirement age, but you're not at that exact date yet, like maybe you turn 67 in August, but you earn significant income from January through August, and it's greater than 62,160, then there's a recuperation of $1 for every $3 earned over the earnings limit for the months prior to reaching, only for the months prior to reaching full retirement age. Once you hit FRA, you can earn anything. You can make Lady Gaga money. You can make baseball player money. Okay, so common question. And really what the Social Security Administration is doing is they're snookering you. They're backing you into a corner. Which do you want to do? You want to work and earn significant income? Great, go ahead, but don't trigger your Social Security benefits. You want to retire and trigger your Social Security benefits? Great, you work forever, you're entitled to them, go ahead and do so. But don't work earning $250,000 a year and elect the Social Security benefits. It's kind of like, pick your poison, or, whichever is most advantageous for you. You can collect your benefits and then rescind your election within 12 months of starting the benefits. I've never heard of anybody actually doing this. You can. And that's like maybe you elect the benefits, but you decide to go back to work. You have to repay the benefits in order to do this. So like, let's say you were getting $2,000 a month of benefits prior to full retirement age. You decide you're going to go back to work and you don't want to work and earn your significant income because of the recuperation that I just referenced. You can halt them, pay back all the benefits you've received up until that point to the Social Security Administration, and then work and trigger benefits at a later date. You can do that. Never heard of someone doing it. Never. Not in 24 years of being a professional advisor. This is a break-even slide showing you the differences between electing early and electing later. So we got 3 monthly payments here. Someone who's entitled to benefits at 62 and they would get a $1,500 monthly benefit. If they wait to 66, they get 2 Gs. If they wait until 70, they get $2,640. Obviously, this is the largest of the benefits, but you got to wait to get it. So what are the break-even points? How long do you have to wait before it becomes a better deal? Well, like for instance, this individual who's claiming benefits at age 62, if they work age 66 versus age 62, the break-even point is here at age 76. They got to live to age 76 before it becomes a better deal to elect benefits at age 66 than it would have been to start them earlier. Well, what's the probability that you live past 76? It's very high, very, very high. So from a pure mathematical perspective, in that instance, electing benefits earlier would not make sense just from a pure wealth accumulation perspective. Again, as I mentioned previously, if you elect benefits at age 70, mathematically, it's how you get the maximum benefit here. But look at what we have the life expectancy going out to. This person's living to 94 years old. Not everybody does that. And you can't even really use the assets from 89 to 95 years old. So look, I'm not telling you to elect benefits early or elect benefits late. I'm just saying that there are decisions and inflection points that should be considered, and we can help you make some of those decisions. All right, spousal benefit. So if you are married and you've been married for at least 1 year, your spouse is entitled to benefits based off of your working record. You have to be at least 62 years old, and one spouse must file for the other to claim the benefits. In other words, working spouse has to file as well. So what are you entitled to? Even if you didn't work, you could have been a stay-at-home parent or just out of the workforce, you are entitled to no less than 50% of your spouse's primary insurance amount at full retirement age. There is the same reduction that happens for spouses too. Let's say you're entitled to half of your spouse's benefit at full retirement age, but you decide to elect benefits at 62. There's a reduction here that happens, 23% reduction that happens. So that should be taken into consideration. Once you hit full retirement age, you max out. And again, the maximum is 50% of the spouse's primary insurance amount. Okay, surviving spouse's benefits. So what if you are widowed or a widower? Your surviving spouse can receive or step up to the benefit of the deceased spouse. Okay, so if you're at full retirement age, you could get as much as 100% of the spouse's benefit, and you can switch between your own benefit and the spouse's benefit. So this is a little known fact and something I am, often surprised that people are not aware of, but widows' benefits start as early as age 60. So if you're in that boat, please consider that, because you may have been entitled to benefits for several years now. Unfortunately, I have this conversation a couple times a year with someone who says, I didn't know I could elect benefits based off my deceased spouse's working record. Yeah, you can, and off of your own. You can choose between the two of them. Okay, so this is an example of a woman named Wendy. She's 60, and her husband passed away at age 66 with a $2,400 benefit. And we're assuming that Wendy lives to age 92, and she's got her own benefits. She worked as well. At 62, she's entitled to $1,500. At 66, she's entitled to $2,000. And at age 70, she's entitled to $2,640. Same numbers that we used in the previous slide. And her survivor benefits are displayed here. At age 60, $1,700. At age 66, $2,400. And at age 70, over $3,000. So when should she elect? So we're showing you the three different examples here. One is survivor benefit at age 60. And then Wendy's own personal benefit from 70 through life expectancy. So she's getting $206,000 worth of survivor benefits for the 10 years between 60 and 70, and then $700,000 worth of benefits based off of her own working record. That's how she gets the maximum payout. However, she's getting a lower amount from 60 to 70. His or her benefits at age 62, and then the survivor benefit at age 66. This person is receiving $72,000 of her own benefits, and then $750,000 worth of survivor benefits. So that's $820,000 of total accumulation, assuming that she lives to 94. Again, huge assumption. I mean, we have no idea what your life expectancy is going to be. And survivor benefits only $660,000 worth of total benefits paid out. But I think you can see here that we're not talking about chump change here. I mean, we're talking about hundreds of thousands, if not millions of dollars of payouts, depending on how long you live and what your income was and when you elect the benefits and so forth. So these are very important decisions that should be taken into consideration when you're doing your retirement income planning with your friendly advisor from Everhart Advisors. Divorced spouses is always a funny conversation because there's a fair amount of acrimony that accompanies this conversation. Often divorced spouses don't like each other. I mean, that's just a fact. So sometimes people think that when they elect Social Security benefits based off of a divorced spouse's working record, that somehow they're like taking something away from the previous or the former spouse. They're not. The benefits are based on the divorced spouse's working record, but it does nothing to affect that individual. Okay, so to receive spousal benefits as a divorced spouse, you have to have been married for at least 10 years. Okay, you have to be unmarried. You cannot remarry. And that part of the conversation actually comes into the conversation like at my mom's retirement community, where you'll have two people who do not get married later in life. Maybe they've been in a relationship for a long time. They don't get married later in life because they don't want to affect potential Social Security benefits. Right? That's a consideration. To receive these divorced spousal benefits, both individuals have to be at least age 62, and you have to be divorced for at least 2 years. That 2-year rule does not apply if the individual was eligible for spousal benefits at the time of divorce. Okay, so if you were both over age 62, basically. And then survivor's benefits, married to the ex-spouse for at least 10 years, unmarried, or married after age 60, and you have to be at least 60 years of age. But it doesn't affect the former spouse in any way. But Social Security will give you information based off of the previous spouse's working record, such as what are you entitled to? So, you can contact them. It brings up another great point, not in the slide presentation. You must go to this website, ssa.gov, and establish login credentials. I know, I get it. We have turned a system that is designed for people 60 to 95 years old into an all online system. No, that's not very efficient. And I get it. There are people in their 70s and 80s who are not web savvy. But if you are about to make these decisions, you should partner with someone, a loved one, an advocate, a child or heir or beneficiary or whatever, and create login credentials for ssa.gov, because that's how you are going to trigger Social Security. You can trigger it in other ways. You can meet with someone at a local office and so forth. But Medicare is also elected through ssa.gov. And I'm just encouraging everyone, if you're leading up to the Social Security decision-making process, a lot of the data that we need to make these decisions, you gather it at ssa.gov. So you should have functioning login credentials. Yes, it is a pain in the butt. So as far as establishing online access, one of the worst websites I've ever worked with. I'm just chuckling because it's like everybody's going to need this thing, but it's run by the government, so it's not extremely efficient. But it behooves you to carve out some time and spend 15 minutes establishing online access to this thing, because it's helpful during the pre-retirement process while you are making your decisions. It's helpful when you are at the inflection point and you're actually pulling the trigger and getting the benefits. And then on an ongoing basis, like Medicare elections and so forth, a lot of that stuff happens through ssa.gov. Oh boy, taxation. Yes, Social Security is taxes. You paid taxes into the system for decades, 6.2% of your wages, and your employer matched it. another 6.2% from the employer out of their pocket. So 12.4% of everything you've ever earned in your lifetime goes to Social Security. Does that sound like a lot of money? 12.4% of lifetime earnings? It is. It's a huge amount of your income, right? Goes to Social Security. And then when they pay it back to you in the form of monthly income, you pay taxes on that. It's not good. I'm sorry to be the bearer of bad news, but that is 100% how it works. So how are Social Security benefits taxed? Well, first of all, taxation of your benefits depends on your provisional income. So the threshold here is, I'm going to focus on married filing jointly because a lot of our clients and the people on this call are married individuals, pre-retirees. If you're making more than $44,000 worth of what's called provisional income, up to 85% of your Social Security benefits are taxable. Okay. What is provisional income? Provisional income is half of your Social Security benefits plus these forms of income: wages, business income, interest, capital gains and dividends, your investment income, distributions from your qualified retirement accounts. Yes, that's what most of your income is going to come from, and rental income. In other words, these are the most common forms of income in retirement. There are some exclusions, such as the growth of money inside of your IRAs and 401k plans is not taxable as it grows, but when you distribute it, it is considered part of your provisional income. Income from Roth IRAs or Roth 401k plans that are usually converted to Roth IRAs at the end of your career is not included in provisional income. Now, that's a planning point. I'm a big Roth guy. I love Roth. I save on a Roth basis. And I like the idea of getting to retirement and having this big old chunk of non-taxable Roth wealth. Then this part of the reason is if I distribute some of that money early in my retirement, like let's say I retire and but I'm still getting like consulting income or something along those lines. I like the idea of being able to have a non-taxable source to take some additional income from, and that's what Roth money is. So, and then non-taxable income from life insurance, very, very unusual. Here's a statement. They used to mail these things out. They were green. You got to go online to get them now. Yes, my lovely mother, who's a wonderful person, but is not web savvy. She does not get a paper statement, or I haven't seen one in a long time. Thankfully, I set up her login credentials and I help her understand her Social Security benefits and so forth. But that's where you get them. So SSA.gov. And it's got great detailed information about your earnings record, the benefits that you're entitled to, and the benefits that you get on an annual basis. What do you get at 62? What do you get at 65? What do you get at 70? All that information is available and displayed on your statement. We're getting close to the conclusion of the slide presentation here. This is referencing what I said at the beginning of the conversation. Will Social Security be there? I don't know. I mean, the idea that we have this social compact between generations, which is what Social Security is. It is an agreement that the workers of today will pay taxes to support senior citizens in their retirement years, with the hopes that when you become a senior citizen, future generations, their tax revenue will pay part of your income. So it's absolutely an intergenerational compact. Well, the challenge is that the pyramid is being inverted. When Social Security was enacted, there were 180 workers for every beneficiary. It's 2.8 workers now for every beneficiary. That's just a huge inversion of the workforce. And you know what? It's a good thing in a way, because the reason the pyramid is inverting is because we're not dying at 62 years old and 66 years old anymore. People are living for a longer period of time. Hooray! That's a good thing. You get more time in retirement than previous generations did. The idea of a 3-year retirement in 1935 was just fictitious. Well, we plan for 30-year retirements now. I mean, I'm working with my clients to get them out of the workforce at 60 and hopefully live to 90. That's 3 decades. Well, it's changing the Social Security Administration. So these are some of the potential legislation changes. Link cost of living increases to different inflation indexes to decrease benefits. In other words, cut the benefits, make the benefits smaller. Increase the retirement age beyond age 67 for younger generations. Yes, for my children who cannot vote. who have no say in this. Yes, grandfather them in. So when they get to be 67, they have a rude awakening. They got to work to 70 to get full benefits. It's probably going to happen. Increase or eliminate the wage cap for payroll taxes, called the taxable wage base. Yeah, the number's probably going to go up. And increase the payroll tax. It's 12.4% right now, split between the worker and the employer as of 2025. You can see that number going up to 15% to increase, to generate additional tax revenue to fund Social Security. Medicare taxes are uncapped. Medicare, I don't care if you make, modest income, moderate income, or baseball money. You pay Medicare taxes 2.45% of your income, and your employer matches that on all of it. And the number is actually greater than that if your income is above $250,000. So it's more than 2.45%. But I could see those being the primary changes that would happen from a legislative perspective to shore up Social Security and make it more solvent. And, I think we need to be realistic about this conversation. When Social Security was enacted in 1935, the poverty rate among senior citizens was around 50%. Half of senior citizens live in poverty. The number's under 10% now. That's good. Social Security is responsible for that. I think you could make a case that it has improved standard of living for senior citizens in America over the last 100 years. That's a good thing. But I am married, okay? And my mom always says something funny to me, which is that a good compromise in a marriage is when nobody's happy. So what needs to happen is these political factions all need to be displeased with the outcome to shore up Social Security. Yeah, we're probably going to have lower benefits, maybe change the benefit formula, and we got to maybe work longer and probably pay more in taxes. And that's just fact of the mathematics of the demographic shifts that are happening in our society. But I'll tell you what, you're not putting the toothpaste back in the tube. Social Security is here. It's been around for close to 100 years now, and it is part of the fabric of our society right now. So it's not going to go by the wayside, and we do need to have it be solvent. So these are some of the potential changes. All right, so this is just our contact information if you have questions about Social Security in general, but I did want to leave a couple of minutes for questions and answers. So if there is a question that you have and you want to put it in the chat, go ahead and type it out and put it in the chat. And I'm going to stop sharing my screen here for a second so I can read these if anybody has a question. There's 6 of them in here. Will we be able to access the recording afterwards? That you have a meeting at 10:30? Yeah, you're going to get an email of this recording. Absolutely. If you are part of a public retirement system and you qualify for Social Security, could you claim against your spouse's benefit if it would be higher than your benefit? And if yes, can you wait until your full retirement age to claim against the spouse's full retirement age, even if the spouse claimed early at age 65? Okay, well, that's a lot of questions in there. Okay. If you are part of a public retirement system and you qualify for Social Security, can you claim against your spouse's benefit if it would be higher than yours? Yes, you can and should. Yes, you can. And if yes, can you wait until 67, even if your spouse claimed early at 65? Yes, you can. If you collect Social Security before 65, do they pay back once you hit full retirement age? I've been told by a financial advisor that it's true. No. If you collect before 65, that is a permanent election, and they do not pay you back once you hit full retirement age. I think what you're thinking of is if there's a recuperation of benefits that happens because you earn more than the annual earnings test threshold of $23,400, there is an amortization that happens for your benefit in the future where the benefit is increased once you hit full retirement age because of the recuperation that you experienced because you failed the annual earnings test. So that does happen, an increase in benefits for people who elected early but failed the annual earnings test. The other concern about delaying taking benefits is that you take assets out of the market and miss the opportunity for them to grow. Well said, Bill McKell. Yes, correct. Compound interest is extremely powerful, as we have seen over the last decade and all of your lifetime. If you take wealth out of those assets I'm not even going to say the wrong time, at any time, you are short-circuiting the compound interest process. But Bill, there has to be a point where we start utilizing our wealth. I work with clients and they can never shift out of the accumulation phase. They get to the distribution phase, the point where they're supposed to be spending their money. They can't bring themselves to do it. They've been conditioned, Pavlovian conditioning, to build wealth their whole lives. And then it's for what purpose? Build wealth their whole lives for what? I would argue for use in retirement. Then they get to retirement and they can't see the forest for the trees. They go, I saved up all this retirement money. I don't want to spend it. Why? What is the purpose? Sadly, I lost my father last year, 73 years old. What if he just kept delaying the utilization of his retirement assets? Oh, one more good year and I make another 10% on $1 million. That's 100 G's. Correct. What about that year? You didn't use the money and then you die prematurely. I mean, I'm not wishing that on anybody, but I'm saying it happens. So it's all just like everything in life. It's a balance. You should strike a balance and be kind of moderate your need for current income with your desire to have accumulating wealth, possibly leave wealth behind future generations. Can you get spouse benefits if you or he remarry? Well, it depends on if you're talking spousal benefits as widow's benefits or divorced spousal benefits. If you remarry, you do not get the divorced spousal benefits anymore, unless you remarry after age 60. So that's a nuance. The other spouse, the divorced spouse's marital status has nothing to do with you. If that spouse remarries, it has nothing to do with you. Does claiming early at age 62 does early claiming at age 62 by the lower earning spouse reduce potential survivor benefits? What about spousal benefits? I don't know the answer to that question, and I don't want to provide incorrect information, so forgive me, Mark. I don't know the answer to that one. Okay, sort of an indirectly related question. Have you heard of pensions whose amounts are decreased by and or related to Social Security benefits? Yes, I have heard of that. Sometimes there are integrated pension plans where the amount you're going to receive from Social Security is taken into consideration for the amount of pension benefit that you receive. And sometimes profit sharing plan calculations or cash balance plan calculations take that into consideration as well. Okay, my late husband died at age 59 and I was 46. He never received Social Security benefits and I got no benefits for being married to him. I'm now 66 and remarried a few years ago. I presume I'm still not entitled to anything from my late husband. So where did all his pay-in go? Oh, good question. Well, first of all, you are 66 and you remarried a few years ago. Did you remarry after age 60? That's a meaningful part of this conversation. If you did, I would call Social Security. And also, are you collecting benefits now? And are you collecting benefits based off of your working record or your current spouse's working record? Because if you are, it's highly probable that those benefits are greater than the widow's benefits that you would have been entitled to, and you would not elect them anyway. But if you have not elected Social Security benefits yet, then it may behoove you to elect widow's benefits based off of your deceased spouse's working record, and then wait to elect benefits either based on your own working record or as part of your current spouse's spousal benefits. Okay, but the final question is, where did all his pay-in go? It goes to the Social Security Trust Fund, and it is absorbed into the system and used to pay out benefits to all Americans. And it is absolutely not right, in my opinion, from an ethical perspective. Should those benefits be paid out in the form of some form of death benefit or, lump sum payout, death, life insurance benefit to the survivors? Yeah, that would make sense to me. Can my husband's ex-wife claim spousal benefits? Yeah, of course. Yes, they can. It has no effect on your family. You said that public employees that paid into Social Security initially is paid out in a lump sum. Yes, I have seen multiple payments for my clients who are public employees, but they paid into Social Security, receive checks this year in 2025. And if that affects you, Steve, you should contact Social Security and determine if you are entitled to a lump sum payment as part of the SAVE Act. Yes, you should. I am a UK citizen. My wife and I relocated to the US in 2017, got our green cards in 2019, likely to work until, say, 65. How do the credits and years of contribution work towards our eligibility to Social Security payments? I don't know. I am so sorry. I would assume that because you are naturalized and have a green card to work in this country, and you will have worked in the country for 10 years or so, that if you were fully insured, that you would be entitled to Social Security benefits. I would believe that, but I do not want to mislead you, so I would direct you to your local Social Security office. Oh yeah, by the way, I'm 54 years old. So if you worked, to 20 to 65, that would be 15 years I'm sorry, 11 years of additional employment. So you're almost certainly fully insured. So I would assume that you are entitled to benefits, and I would check. Right, it's 11 a.m. And that's the last question. So I'm going to conclude the question and answer session, and I'm also going to thank everyone for your attendance and remind you that we conduct these sessions every month for Advisors University. And when you registered for this one, you registered yourself to get recordings of our various presentations on a monthly basis, and they're great. I mean, some of them talk about how do you purchase a home. One of them is about Medicare, the difference between savings and pre-tax savings, or estate planning, intergenerational wealth transfer topics. So really valuable. Consider signing up for them in the future and tell your coworkers. All right, I will conclude it there, and I wish everyone a happy Halloween. Thanks, guys.